Well, one of the more recent additions we had to the portfolio is a company called Catapult, which we invested as a pre-IPO opportunity. They came to us around about 9 to 10 months before they were planning on IPOing, because they needed to raise some money to actually take out their nearest competitor, to beef up for the IPO. So we got in a great entry price at that point in time. One of the beauties of investing in the pre-IPO stocks is while you get them at a discounted price because of the lack of liquidity, you also get unbelievably great access to the management, so you can really get on top of these companies well before the market even has a chance to even see these companies. So yeah, that's subsequently listed maybe about 9 months ago now, I think it is, and it's just gone from strength to strength. Fabulous company with a fabulous outlook in front of it. The most compelling thing about Catapult is just its underlying technology. It is the leader in GPS tracking of athletes. There's a bunch of competitors out there, but they're really using first and second generation of the Catapult product itself. What makes it great for the actual teams is this provides them unbelievable amounts of data about their players, about their work rates, about when they're likely to be injured, so they can actually manage their players very well. Critically, it's not capturing their salary cap. So for these teams, they can only do so much for the salaries of the players, so they throw a lot of time and effort and money at the other stuff, the physios. This is just one tool they can add to their product suite. They can really add them to grow and to leverage the advantage. What we also see from Catapult is it's kind of a chicken and the egg thing. Once enough teams in a particular league using the Catapult system, it becomes a Me Too product. All the other teams are suddenly flooding and want the product themselves because they can't be at a competitive disadvantage to the other teams in the league. Our high level valuation is still many times higher than the current share price. And why do we say that is this company at the moment has only penetrated around about 5% of elite athletes in the world. If you look at their play, their client list, it's the who's who of international soccer, American football, etc. But they still only got 5% of all the athletes out there. So there's still an incredible runway in front of it. So it's a bit hard to get a definitive valuation on Catapult given how long that opportunity set is in front of it. What we do know is the upside's plenty from here. One of the things we always see with the market is analysts and fund managers like to cluster in the pack. There's safety in the pack. There's safety in having your numbers close to someone else's numbers. And when you have a company with such a tremendous runway, it's sort of what's the right number? Will they get 10%? Will they get 20%? Will they get 35%? It's hard to come definitively down to a particular number. And when you do modelling a company like Catapult, you put in 35 or 40% market share, you start getting enormous valuations. It doesn't look sensible to the share price. So then people back away from that and put more conservative, then more conservative, more conservative, until they end up with a number which they can kind of live with. So this is one of the common mistakes, or one of the opportunities that we exploit a lot, is a lot of professional fund managers are following not so much the recommendations, but the earnings forecasts provided by the broking community. The broking community, they don't want to stick their neck out. I was a stockbroker for 14 years. If you can have an earnings forecast that's a bit above the market, get your price target, it's 20% above the current share price, you've got to buy. You don't need to be a hero out there with a huge earnings forecast and a huge bang the table buy recommendation, because there's risks associated with that. Now, we use our judgment looking at what companies do and the pattern of behaviours that we normally see from companies and go, well, this is going to likely be the outcome. It may well take 2, 3 or 4 years to play out, but we can form that judgment pretty early on and back our judgment that this is how the earnings are going to unfold. That's where we can see the big upside.